You may have heard it said that the best place to save is in a qualified plan.
Today we're going to talk about qualified plans, what they are, where and why they came about, and have they been as effective as they were planned to be. Qualified plans first came about because in the mid-70s, the government thought that they needed to help us save more money. Pension plans were not performing as they had been planned to do. And so they thought, well, we'll just set up what they called an independent retirement account. And in 1974, independent retirement accounts, or IRAs, became a place where you could put money before taxes and let it grow tax-deferred until your retirement.
So how's that worked out, Tom?
Anytime the government steps in and tries to help Americans save, and we can go back to Social Security, people begin to think that the government is going to take care of them rather than themselves. And so in 1973, the year before the IRA was introduced, Americans were saving almost 12% of their income, which was about $1,400 and some odd dollars a year. Today, that would be over $10,000, nearly $11,000 that people would be saving in today's dollars. You think that people are saving that today?
Well, they aren't. And I do have that exact number here. We figured out that would be like $10,798 in today's dollars that people were saving of their own accord before the government came in and said, here, let us help. And that equates to about $30 a day, just under $29 something, just under $30 a day. And that's not happening. That's not what we see happening with many people. Some people are doing that, but by and large, people are not saving $30 a day towards their retirement.
Well, something that's really unique happened. The middle class used to own 37% of America's wealth back prior to 1974. Today, they own about 26% of America's wealth. So the middle class has not gotten wealthier because of the IRA. And of course, in between when the IRA was introduced in 1974, we have, the 401k that was introduced in 1981. And then in the 90s, the Roth IRA was introduced, trying to get people to save even more. And all these plans are qualified plans that the government qualifies, and they're exceptions to the tax code, trying to get people to save more money, but it's not working.
So was it Ronald Reagan who used to say, the government comes knocking on the door saying, I'm the government and I'm here to help. And that's not a good sign.
That's not a good sign. There's a new savings plan that's coming about or trying to be evolved in Congress right now, and they're calling it MAGA accounts. And it stands for Money Account for Growth and Advancement.
Okay, so we can expect growth and advancement. So tell us about this account.
What the proposal is right now, and it's passed the House, and the Senate now is negotiating, and we don't know exactly how it's going to end up. But in the House, they're saying, okay, between now and 2028, if you have a baby, the government is going to give you $1,000. Well, first of all, where did that $1,000 come from? It came from your and my pockets.
Yes,
we're the ones. The government doesn't make anything. So they're robbing Peter to pay Paul.
That's already something we don't like.
And that's only good until 2028 because, people realize that would really cost a lot of money if people started having a lot of babies.
So if you have the baby between 2025 and 2028, then you get money. But if you wait till longer, you don't.
You don't.
That's interesting.
But everybody can open one of these accounts. If it's not a new baby, you still can open an account, but you're responsible for putting all the money into it.
Okay, so if you have a baby, they give you a baby present. But if you already have the children and open one of these accounts, sorry, you're too late.
That's right.
Okay.
These accounts, you can put up to $5,000 in them without paying taxes on it. So that's pre-tax dollars that are going into another qualified plan. And you can't touch that money until that child is 18.
Not at all?
Not at all.
So you're locking your money up.
And then at 18, the 18-year-old can access 50% of the money that's in that account for either education, to start a business, or to buy a home. But the other 50% has to stay there until they're 30 years old.
So if the government puts in $1,000, and then you said the parents or grandparents or whatever can put up to $5,000 a year in this. So let's say, a baby is born, they get the $1,000. Every year they put that maximum contribution of $5,000. What can we expect to be in there by age 18?
Well, first of all, it's very unlikely that people are going to put $5,000 in there because the average person saving today is saving between $2,500 and $3,100 in their 401k.
Well, you and I know that. And the other thing is, if someone is going to do this just to get started with that $1,000 from the government, that's a very good sign that they are not at the place where they're going to be able to put maximum contributions. But let's let this be a very extraordinary case. And let's say they actually did put the maximum contribution in every year.
So 5,000 times 18 is $90,000.
Okay.
And
then the 1,000 from the government, we can't forget that. That's 91,000. And then what can we expect it might grow to be?
Well, here's the other limitation on this MAGA account. It can only be invested in one single index that's United States based. So like the S&P 500 or the Russell, it can't be invested across the board like a mutual fund so that possibly when one sector is bad, the other sector is boosting it up. It can only be in one sector. And so one index, one US-based index. And so we looked at the S&P 500 and what it's done over the last 18 years. And if these MAGA accounts perform like they have over the last 18 years, then that will generate around $155,000 for these people.
So then at age 18, they can get half of that.
They can get half of that, but here's another tricky part. The House wants to make this money when you take it out completely tax-free, but the Senate is saying, no way, that's going to cost American taxpayers too much. So we want to tax it as a long-term capital gains tax when you take it out, which is 20%. It could be even more than that if you access this money earlier, because in a 401k, if you access money in the first 2 years of an account, there's a penalty of 25%. If you access it after 2 years that you've started a 401k for a non-qualified reason, then the penalty is 10%. So there could be huge penalties on that. We don't know what's going to happen with these MAGA accounts yet because the Senate's not done with it.
And two, with these accounts, again, this is not a contract. This is just a plan. And since the government creates the plan, the government can change the plan all along the way. So we could be looking at the rules now. And when that child is 18, the rules might have changed. Maybe there won't be any tax. Maybe there'll be less tax. Maybe there'll be a whole lot more tax, or maybe they won't even be able to access as much as 50% like they're saying right now. Okay, so what if they don't access at age 18? When else could they access?
Well, they can access it between 18 and 25, 50% of it. And then after that, they have to wait until they're 30 to access it. At 30, they can access it. And again, what's the tax going to be on it? We don't know yet. And so what's happening here is the same thing that's happening with people's 401ks and IRAs. They're locking up money for someone else to take care of that gets to use it and give you a share of the profits they earn, instead of you having control of your money and being able to access it and to recover the cost of finance like we teach with the infinite banking concept.
And all these qualified plans, and maybe even MAGA, it's not necessarily that they are bad. It's just that they are limiting. And they could end up being bad, but it doesn't mean that they're bad in and of themselves, but they may not be the best that someone can do.
That's right. The 401ks have made some people millionaires, but very, very few. I mean, less than 10% of the population. And it's those people that have had really good jobs that their employer helped match, that they stayed with that job for 35, 40 years, because then the compounding growth can really benefit them. So we're talking about the maximum here of 30 years of compound growth on these MAGA accounts. So they're not going to get the advantage of a 40-year career.
Well, and then too, the access of it, you mentioned that, if they hadn't accessed it by age 25, then they have to wait till they're 30. And what if an opportunity comes along when they're 27? Well, tough luck. You can't access it. And that's often with qualified plans. You're locking money up and you have very strict rules about how and when you can access it. And it makes a very difficult place to be keeping your money so that you can use it later. And then, Tom, you looked at how the S&P has performed. There's no guarantee it's going to perform that way in the future.
No, we always have to look back in our lifetime to 2008 or 1982, when these markets collapsed and people lost anywhere from 40 to 80% of what they thought was theirs. And this could happen in these accounts too. When it's tied to just one single U.S. index, it could make a huge dip in what you thought was going to be there for you when you're 18, 25, or 30.
At McPhee Insurance, we are not problem-oriented, we are solution-oriented. So when we get back from the break, we're going to talk about things that we think are better than qualified plans.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted process of buying a policy to borrow from the policy so you can pay interest on your own money and still come out ahead? Could it be that some people selling infinite banking policies have made it seem exclusive just for the wealthy or financially savvy? Could it be that insurance terms such as modified endowment contract, 7-pay test, direct recognition, overfunding, and paid-up additions are hard to understand? We think the answer to all of these questions is yes. Infinite banking, as most people know it today, is too complicated and confusing, but it didn't used to be. That's why we've put together a binder called Infinite Banking Made Simple. It's just the essentials, no mind-bending magic or number gymnastics. Included in the binder are answers to the top commonly asked questions, like what is infinite banking, how does it work, and how much does it cost to start. We've made the binder available to you as a free digital download. Click the button to get your copy of the Infinite Banking Made Simple binder. You can also get a copy of this binder at mcpheeinsurance.com.
When people think and talk about managing money and getting ahead financially, they often think about investing or using some qualified plan for someone else to take care of their money so they can get ahead. But according to the U.S. News and World Report, 42% of Americans today have no savings at all, while 82% of Americans own more than one television, and 54% of Americans have 3 or more televisions in the home. Most Americans own 2 cars, and this is ironic, most people have more than 2 connectables, like a smartphone, a wearable, a laptop, or something like that.
So many people are trading what they want most for what they want now. Rather than saving for their future, it's easier to, or maybe seen as more desirable, to buy the next gadget.
And not that those gadgets are wrong, and not that having more than one television in the house is wrong. It's just that the idea of saving in America has been lost because of all these government programs that say they're going to do it for you. And they're not going to do it for you. The people that have become 401k and IRA millionaires are the people that are putting the most money into it. You look at the statistics, it's not the returns that they're making that are generating that. It's what their employer or what they're putting into these accounts and how much of it they're diligently stocking away that's making the difference. And they've decided that they're going to go without today so they can have more in the future. And that's what's made these accounts grow. So it behooves people to understand that there's a place to put money that you don't have to wait till you're 60 before you can tap into it. And if you tap into it correctly, you can have even more money when you turn 59 and a half and 60 to live those golden years.
And we are talking about participating whole life insurance, where you have control of what you pay into your premiums and you have control of when you access the money. And it is a guaranteed contract telling you just how the policy is guaranteed to perform. And of course, it can perform better than that. And you have control of how the money performs in that as well.
So when you were talking earlier about those MAGA accounts and what people were saving before the first IRA was introduced in 1974, you were saying that that would be equivalent to about $30 a day today. So let's make that a little bit more real. What does $30 a day today look like?
Well, I went out to lunch with a group of ladies the other day, and I know I spent around $25 for lunch. That was a salad, a drink. Of course, I tipped the waitress. That was about $25. And so we could say lunch out could be close to $30. Sometimes it might be $30 or more, and sometimes a little bit less.
Yeah, $30 in Nevada wouldn't have bought you that, because lunch out was a lot more expensive there. And if you live in New York City, it's a whole lot more expensive, or Los Angeles. So there are places where $30 goes a lot further in America today than other places. But we're talking about averages here. So if someone was to put $30 away every day, that would make them be saving about 12% of their income, just like people did before 1974 when the IRA came out. But let's not even use that number. Let's just say that people contribute $5,000 a year to a life insurance policy instead of a MAGA account. What's going to happen is if they design a policy with high cash value, like we design here at McPhee Insurance, they'll have about $112,000 of cash value in that policy by the time that child is 18 years old. And they'll have over $750,000 worth of death benefit. That's going to help the next generation.
MAGA accounts don't have that. And that's something that we're not looking for the immediate. That's just, like you said, it's going to be for the future. But that $112,000, now, at 18, they'll have that $112,000. Is that when they can access it?
No, they can access it really after the first time they put their first $5,000 in there, because there's going to be about 60% of that $5,000 that they can access to maybe buy baby clothes or to buy a stroller or to do something else. And now if they just pay back the policy as if they would have paid a credit card or paid cash for it at the store, they're going to build that cash value, and it's going to be much larger than $112,000 by the time that child turns 18.
I love the fact that there's no limitations about when you can access that money or when you can't, because there are things that come up along the way that you might want to use those funds for. And I'm thinking particularly a student, getting towards their senior year, they might decide that they want to study abroad. We've seen that happen with our clients. And the parents can access the funds in the life insurance to help foot the bill for their student to study. And usually that student is less than 18 years old.
Absolutely.
They can access 50% of it. They can access whatever they want of it, all of it if they want.
I think one of the issues that is wrong with savings mentality today in America is that it's an afterthought. It's like, okay, I'm going to take care of my cell phone bill. I'm going to take care of my cell phone payment that I'm buying on time. I'm going to make sure my car payment gets on time. I'm going to make sure my house payment or my rent gets paid. Then I'm going to make sure that all my lunches are paid for this next month. And if there's anything left, I'm going to save that. And that is Parkinson's law. There's not going to be anything left to save if we approach a budget like that. We have to start with, what am I going to do first? I'm going to save this X amount of money. It was 12% before 1974. What is it today? It's less than 5%.
And the reason people were able to say that back before 1974 is because they did think of it differently. They knew that they had to save, and they made that priority. And we understand how it happens that you spend on all these other things and then, there's nothing left to save. We're speaking from experience. You have to change your mindset, change your way you're thinking, and plan to save so that it gets done.
I was talking to a client the other day, and she's buying some property in Costa Rica. And she said, Tom, I just had screens put up on the window because they just have bars here in the window, and because critters were coming in.
Ooh.
And I want to learn to live down here without air conditioning, because air conditioning is really expensive to run, and I'm just trying to acclimate myself. And I remember back in the 60s when I was growing up, nobody had air conditioning except very few people. I remember going to Houston, the armpit of the South, and visiting my cousins and dripping wet. And that was just what people did. And we'd all huddle in the dining room because they had one little box window air conditioner. And it's like, wow, that's cool air. It feels good, But driving in the back of our, 56 station wagon, windows all up, going down the freeway in 90-degree weather across the deserts and getting there from Oregon, no air conditioning. We didn't complain about it. But now air conditioning has become a necessity in our life.
Well, I kind of feel like it's a necessity in my life.
Now, is that wrong to have air conditioning? Absolutely not. We enjoy the comfort of it. But that's how Parkinson's law creeps into our life. And once we experience something nice, we say, oh, we want that all the time. But that's not the way to save. Mm-hmm. And if we want to have more tomorrow than what we have today, we have to limit ourselves on what we want today so we can really get to what we want tomorrow.
And that's what this client was talking about. She enjoys the home in Costa Rica. She enjoys many of the things about that. And so she is helping herself to learn to enjoy it without some of the conveniences that she has been used to, because she values her experience there.
It's not that she can't afford the air conditioning. She's very well to do. But she's trying to live in Costa Rica like Costa Ricans live. Mm-hmm. It's very important that we understand that we're not competing with the Joneses here. We have to compete with ourselves. That's the biggest competitor for getting wealthier. And if we don't want to depend on somebody else, namely the government, to take care of us when we get older, we need to be thinking about, first and foremost, what am I going to put aside today? And where can I put that so that I'm not locked away from my money and I can manage it so that it can grow for me and I can keep all the profits instead of letting someone else manage it, like in a 401k or an IRA account where they manage it and they get to keep most of the profits and give me just a percentage of it.
And opportunities don't just come up at certain time periods named by the government, when you're 18 to 25, and then at the magical age of 30. Our son, our youngest son, he's used to saving money, and I have an example of his leather work here. He got interested in leather, and he went to a tool shop where a man was getting out of the business. He was retiring, and Jordan bought leather tools for pennies on the dollar. And here's an example of this beautiful cover he has made for my Bible. And he has a stitching horse, so he can do all this fine stitching, and he does beautiful tool work. He was used to saving money, so he was able to take advantage of that opportunity that happened when someone was going out of the business.
Savings is so important, and because, like you said, there are things that come up in life, whether it's a baby stroller when the baby's first born, or whether it's their first computer when they have to have one for high school or junior high, or whether it's their first automobile or a family vacation, or, like you said, studying abroad. Those things that happen, extracurricular activities like sports or music, a musical instrument that you need to buy for a budding musician. Those are things that we don't plan for, but that naturally come up in life. And if we've been saving in a place where we can access money and it not be penalized for accessing it, we can actually get ahead and make those purchases become something that makes us more affluent. And that's why we talk about infinite banking and participating whole life so much.
And participating whole life insurance, it is a contract. It is guaranteed. It is not going to change. The rules for accessing the money is not going to change either.
Savings is the seed for generating wealth. You either sow it with someone else and they water it, nurture it, husband it, take care of it, and they keep most of the profits and share a little bit with you, or you sow those seeds of savings in a life insurance policy where you control it, you manage it, you nurture it, and you get to keep all the profits for yourself.
What if you've managed to save up a large sum of money or a windfall has come to you? We're going to talk about what to do to preserve and protect that money next week, right here on Wealth Talks.